Here we go. Hi, everybody. Happy Thursday. I hope everybody's doing well. We got about a good 24 people on the call right now. So we'll just, I'll do a little introduction to allow people to join us that are running a little bit late. First of all, I want to thank Laura at Tri-County Associations for inviting me to do this title class. We've done a couple of these now, and I like to think they've been all really well received. So thank you so much, Laura. Thank you so much, Tri-Counties. For those of you that I have not had the pleasure of meeting, either in person or virtually, my name is Jerry with First American Title. I am the account rep here at First American Title, mostly servicing, East St. Gabriel Valley, borderline Orange County, Riverside, and Inland Empire, since we're all sort of in this little Tri-County corridor. But many of you I've had the pleasure of meeting already. I see Tony on here, Amy, Nari, a lot of people that, we've had the pleasure of meeting before. So thank you guys so much for being on this call. So today I'm going to spend about an hour with you guys. We're going to be talking about title insurance. This is mostly going to be covering about everything from basics, what is title insurance, to what are some of the different investing methods. I'll also be talking about some of the red flags on title if we have time, but also I want to make sure I cover some of the more sort of title issues that we've been seeing during the this COVID time. Since about March or April, since everything's shut down, there's quite a few things that we've kind of had to work around or be different. So I'll talk a little bit about those too. And that should take up most of our time here for the hour. Now, I know some of you guys on here are seasoned agents. Some of you guys are, maybe a little newer agents. So for the seasoned agents, just bear with me. I am going to have, spend maybe a little bit time talking about some of the basics of title insurance. So I hope that's okay. Hey, Charles, thanks for logging on. All right. So give me a second, guys. I'm going to share my screen. All right. Hopefully everybody can see that. If not, let me know. Guys, I don't, usually I have I have Eric on my team here to moderate for me. So if you guys have questions, usually he's kind of checking the chat room for questions, but I have him doing a training for something else right now. So I'm not gonna be able to have a chance to check the chat room. So if you do have questions, you're welcome to just unmute yourself and ask. So feel free to stop me anytime, okay? All right, let's get going. So what is title insurance? All right. Now, this says that title insurance protects you against a covered title defect like a previous owner's debt, liens, and other claims of ownership that may have been instituted prior to the purchasing of your home. What does that even mean? I'll be honest with you, I don't even quite really understand that. In layman's terms, all that is really saying is that title insurance protects you so the home that you purchase is yours. That's really it. It's an insurance for ownership, right? Insurance for ownership. Now, you might ask, why do I need insurance for ownership? If I give somebody money, doesn't that mean I own this product, right? If I give somebody money for a car, then it's my car. I mean, I have insurance, but it's in case if I get into an accident, not to say that this car is mine. I don't have like an insurance for ownership, right? If I go to Best Buy or Target and I buy a TV and I give them money, they give me a TV, it's my TV, right? There's no question. So, but real estate is a little bit different. It's a lot more complex, right? So there's a lot more moving parts. There's a lot more chances of fraud happening. There's a lot of chance of mistakes. So real estate basically is one of the only things out there that you can buy an insurance for ownership, right? Because what happens if, say, you buy a house and 2 months later, somebody comes knocking on your door and says, hey, I own, a third of this home. It was passed down to me by my cousin. I never agreed to sell you this house. So I need money. Right? Now your ownership is threatened. Or what if you purchase a home and a previous lender comes back after you and saying like, hey, we loaned, $100,000 on this property as collateral. We never got our money when the home was sold to you. Pay up, right? We've seen these situations all before. Or what if the home was sold to you by a person that's not really the seller, right? What if it was a fraudulent person pretending to be the seller so he or she can take the money and run? And now technically you don't own the home because the real seller never actually sold you the home. Or those are some of the bigger issues, but even smaller things like what if you purchased lot 5 of track 1, 2, 3, 4, but then you ended up getting lot 4 of track 1, 2, 3, 4, right? Even those little things can affect your ownership. Now, that's what title insurance is here for. So we talked about how this is different from traditional insurance policies. Traditional insurance policies, guys, you all know this. We all have it. Car insurance, health insurance, etc. Right? All those insurance more or less work the same way. You pay maybe an annual premium. You pay twice a year. You pay every month in case something were to happen. While title insurance works backwards. See, we do all the work up front before escrow closes to make sure nothing happens in the future, right? And then there's only a one-time premium that's typically paid through escrow. And so that title policy is good for as long as the owner owns the home, right? As long as the owner owns the home with a one-time premium. There's not an annual premium, nothing like that, as long as the owner owns the home. Now, in a typical transaction, right, in a typical escrow transaction, there are two types of title policies that gets issued. One is our owner's policy. I hope you guys can see this mouse. Owner's policy. The owner's policy is what I talked about earlier. It's good for as long as you own the home. Here in Southern California, typically this is paid for by the seller, even though it's insuring the buyer, right? It's giving a title insurance policy to the buyer. Typically speaking, the seller pays for it, right? It's all negotiable. Of course, there's no law that says the seller has to pay for it. It's just the way we do business here in Southern California. If you go to a new home builder, the home builder might have you pay for everything, right? Might have the buyer pay for everything. So there's no, black and white way. Now, the second type of policy is the loan policy, right? This one is to insure the lender if there's a loan. Right? If the buyer is taking out a loan to buy a property, then the lender, let's just say it's Bank of America, right? Bank of America is going to require that the buyer also purchase them a title policy. Now, this loan policy is a little bit different, right? One, it's less expensive. Two, the buyer pays for it. Three, it's only good for the term of that loan. What does that mean? That means it's not like the owner's policy, right? Sorry, the phone's going off. I apologize. It's only good for the term of that loan. So let's think about that. Every time you refinance, what happens? You're getting a new loan, right? Because you're paying off an existing loan and you're getting a new loan. So whenever you refinance, there will be a new loan policy that gets issued, even if it's with the same lender. A lot of people ask me, well, I just refied, my loan was with Wells Fargo, and now I refied also with Wells Fargo. Do I have to pay for another loan policy? And the answer is yes. All right. Now, let me give you guys a little tip about this owner's policy. Going back to this owner's policy now here, okay? The owner policy, remember guys, like I said earlier, it's good for as long as you own the home, right? Now, what happens if I transfer it to my own LLC, right? Let's say Jerry Wu, I bought the property as an individual, and then, I transfer it to, I have an LLC called JW LLC. Well, technically speaking, if you transfer title out of your name, your title policy is done. It's void. It's no good, right? Now, if you were to transfer it to your own LLC, this is a quick tip. Title companies offer what's called an endorsement. Endorsement is just like another fancy word for add-on, right? An endorsement to continue coverage. It's only like $100. I'll tell you a story. It happened. It didn't happen in one of my files. It happened to one of my lender friends. One of his clients purchased the property, right? And then within 2 months or a month, really quick, he transferred it to his own LLC. And I think like within another month or so, he got a letter in the mail from the previous owner's lender saying that, hey, we lent money on this property and we just noticed that it got paid. So we see that you're the owner and the house is collateral for our loan. You got to pay us. So what this guy did was he filed a claim with this title company, and I forget what title company it was, but he filed a claim with this title company, and this title company denied his claim. And he was like, "What do you? How could you deny my claim? My ownership is threatened." And they said that it was because that he had it in his LLC and he did not get the endorsement. This is a really funky situation because what ended up happening was that seller, the person that sold the home to him, actually did have that loan, but for some reason, that lien, the recorded lien for that loan, got recorded in the wrong county, right? So when that title company did the search when it was in escrow, they did not find that loan. And because they didn't find the loan, the seller didn't say anything because he figured, well, if I don't say anything, then I'm going to get my full amount of my proceeds. So it was a pretty bad situation, and unfortunately, he didn't have title coverage. Now, in our community, I also notice a lot of people change title back and forth, right? Like, let's say if I buy a property, I change it to my mom's name, or I change it to my dad's name, change it to my friend's name, whatever. If that were the case, title policy is done. All right, no more title policy as well. So keep that in mind. A lot of people don't get a new policy, and the reason is because they're expensive, right? A $500,000 home is about $1,600 for title insurance. So a lot of people don't get a new policy, but you can, but you don't have to. There's no law that says you have to. I will say this: most title claims, all right, statistically, most title claims happen within the first 1 or 2 years. So you take that, and run with it however you like, right? So if you feel like, hey, there's not a lot of risk, then hey, cool. So, I would never force you to buy something that, you don't think you need. So I talked about this already. Owner's policy lasts as long as you own the home. Loan policy is only effective for the life of the loan. All right, this is just some of the costs. So with the cost, again, it's based on purchase price and loan amount, right? So our owner's policy is going to be based on the purchase price. The more expensive the purchase price, the more expensive the title insurance premium is, right? It's just like any insurance, right? The more expensive your car, the more expensive your insurance. So the loan policy is based off the loan amount. So if the buyer's loan amount is higher, then the loan policy is more expensive. All right, I think I'm going to skip most of this. And actually, before I move on to this, now, since we just talked about price, now I'm going to teach you guys what a binder is, binder, okay, an interim binder, because a lot of people ask us, Jerry, is there a short-term policy, right? And I'm like, well, what's a short-term policy? They're like, well, short-term, what I mean is, I want to buy a property, but I'm going to sell it probably, I'm going to flip it or I'm going to sell it within the year. I don't want to pay for title insurance. I've only owned it for like a year. Is there a short-term policy? And the answer is no. But if you go into an escrow knowing that as a buyer, knowing you're going to sell the property within 2 years, all right, the magic number here is 2 years. If you know you're going to sell that property within 2 years, make sure you request from the title company that's working on the file that you want an interim binder. It's spelled binder. Right, I'm gonna change it up a little bit so you can actually do some drawings. It's called a binder. Right. So this is how a binder works. Let's say you buy a property for, excuse me guys, give me 1 second. Let's say you buy a property for 500,000, right? And then the seller, you're the buyer, remember, all right? Now as the seller has to pay about 1,600 for a title policy. Now, as the buyer, I'm probably going to sell this property within 2 years, right? So what you do is you quest for this binder, and then you're going to pay 10% of this title premium. So that would make it 160, 10%. Now, you buy this property, maybe you're flipping it, whatever the reason, as long as it's within 2 years, you're going to sell it for 600,000. Remember, I said that the policy amount is based off the purchase price. The more expensive the purchase price, the more expensive the policy premium is. So let's say you're going to sell this for 600,000 and you're the seller now, and then normally as the seller you have to pay $1,800. That's how much it is for a $600,000 home. All right, I'm kind of just guesstimating these numbers. So as the seller, you're responsible to pay $1,800 for title insurance for the buyer when you turn around and sell it. But when you're in escrow selling the property, you're going to say, wait, hold on, pause. I'm not going to pay $800 or $1,800 because I have a binder. What you're only actually going to pay is the difference between this, all right, which is $200, right? So all you're going to be paying is $200. So in total, you've paid what? $200 plus the 10% in the beginning. So in total, you paid $360. That's a lot better than $1,800, right? So I hope everybody understood that. If you don't understand, if you want me to repeat anything, just feel free to unmute yourself and ask me any questions, okay? Now, there is a couple of rules for this binder, right? So the first rule I already talked about, and that is that you have to use it within the first 2 years of buying the property. If you want to extend to the third year, you can. You just have to pay another 10%, which is this $160, all right? Usually it doesn't go beyond 3 years, but usually not even that many people get this third year, but typically that's how it works. The second rule is that you have to use the same title company that issued the binder when you sell the property. So when you sell the property for $600,000, if First American issued the binder, you have to go back to First American Title when you sell the property. Okay? All right, let's keep moving along. So I'm going to talk a little bit about vesting. Sorry, I have this Chinese form here, but here we go. Here's some English ones. But before I do, before I talk about vesting, let me take a couple minutes to talk about some of the, I promised you guys that I would talk a little bit about some of the things that changes that we've been seeing because of COVID. So I'll share some with you guys now. There's a couple of points I really want to stress, all right? So here we go. Number one, notaries. All right, notaries, guys, have been an issue because it's so easy to commit notary fraud. All right, so right now, it's very important to know that with notaries, most title companies, and these keep in mind, these things that I'm talking about are not specific to First American. They're in general most title companies. All right, here most title companies will not accept a recording document if it was not notarized in escrow. So the only people that should be notarizing documents should be either the escrow officer, a notary that was set up by the escrow officer, right? So maybe the escrow officer has a personal relationship with this notary and they said, no, I'm going to send you there to sign. Or a First American Title approved notary. Most major title companies have approved notaries, right? So we have a list of approved notaries. I can let you know who those are if you have somebody that need it. But who were not, who should not be notarized documents are like people at a UPS store, right? Or just taking it to a bank somewhere and having it notarized. So because we run into a lot of situations where people don't want to go into escrow. So then they just take the document, they take the grant deed or whatnot, they take it down to the UPS store, local UPS store, and then they have it notarized there, and then they send it to the title company like 2 days before closing. And then when the title underwriter gets that, they're like, I don't know this notary, this isn't going to work, right? Or we need some more validation. Then that creates issues, right? So please make sure you keep that in mind when you're setting up these notaries. Also, with the county, right? Now, as you guys know, the county recorder office is obviously still working. You know, we're recording documents, we're closing files, but they're closed to the public, right? So meaning that nobody can actually walk into the county recorder's office. Now, this brings me to the point of special recordings, all right? Now, for those of you guys aren't aware, special recordings are when you fund and record on the same day, right? So when you have the buyer funds the loan and records on the same day. Now, this is perfectly fine for Orange County, San Bernardino, and Riverside County, right? So we have until about a 2:30 or so cutoff time to get the buyer's money's lender's money and all the recording docs. And if everything's here, we can submit it the same day by around 2:30 in the afternoon, and it can still record that same day. What does not work is LA County, right? LA County does not allow for special recordings. That means that if you wanted to record on a Friday, everything has to be set up on a Thursday, meaning the money from the lender has to be at the title company by Thursday. All the recording documents have to be at the title company by Thursday for it to record on Friday. In the past, if you wanted to fund and record the same day in LA County, we had to go with the buyer in person. Like I would maybe meet the buyer and we have to go in person to the county recorder office, and then we walk it up to the counter and do a recording. So we did that, Charles, we did that one earlier this year. So, but because of what's going on right now, you can't do that anymore because remember, we can't go to the county, it's closed. So meaning with LA County, you cannot do special recording, all right? There's just no way around it. A lot of people have asked me lately, like, oh my God, I gotta close this file. And it's just one of those things and I have nothing to say except I'm so sorry, our hands are tied. There's literally nothing we can do. So that's just one of the unfortunate downfalls of what we're seeing right now. Also, certain departments at the county are closed. I mentioned it at a C21 meeting yesterday, but Tony, I don't know if you were on that meeting, but I had mentioned that some of the departments, for example, one of the departments that authenticates translations, they're closed. So if you have a death certificate that needs to be recorded for a file, like let's say two people are on title as joint tenant, one of them passed away, and they passed away in say China, and that death certificate needs to be translated and authenticated by a court-approved translator. Well, the authenticator is not, they're not working. So, so that becomes an issue. All right, so just a couple of tidbits and we'll get back to the whole title class thing. Linda, okay, I'm just going through the chat. Linda asked, title change to living trust, shall we get endorsement too from title? If it's going to your own living trust, Linda, it's okay, right? If it's going from Jerry Wu to the Jerry Wu Family Trust or the Wu Family Trust, that's fine. I'm the owner, I'm of the property, transferring to my trust where I'm the trustor, perfectly fine. You don't need a new policy for that. It's only when you transfer it to another individual or when you transfer it to like a company, like an entity. Okay, let's get back to the vesting methods. Okay, so let's talk a little bit about vesting. Vesting is ways to hold title. You guys have all heard of it before, you know, joint tenant, community property, tenants in common, single man, married man, unmarried man. What does all this mean? So I'll take a little bit of time to kind of go through all this with you guys, okay? Now, when we talk about vesting, we're really talking about estate planning. And estate planning is what? What happens to my stuff after I die, right? What happens to my stuff after I die? So a lot of these things, a lot of these vesting methods will have that to consider. All right, so hopefully you guys can all see the screen. So the first method is sole ownership. All right, sole ownership. Now sole ownership is pretty straightforward. There's really only a few ways to hold title as sole ownership. So let's create a fake owner. Let's call him Michael Smith. All right, that'll be our guide today. So Michael Smith, if he owns a title by himself or owns a home by himself, he could be Michael Smith, a single man, or Michael Smith, an unmarried man, or Michael Smith, a widower. Okay, so a single man is pretty, I don't think I need to explain a single man. An unmarried man All that is a married man who's been divorced. So if you're married, you're never single again, right? And then a widower is just somebody whose spouse has passed away. Now, if Michael holds title as any of these methods and he were to pass away, right? Let's say he gets into a car accident, he passes away, that property is automatically going to probate, right? Meaning a court has to determine what happens to Michael's property. Now, what if Michael was married and Michael's a married man holding title as his sole and separate property, right? So he could do that. His spouse would need to sign the quitclaim deed, allowing him to hold title by himself. All right. I know many of you guys are aware of that. But some people ask me, Jerry, can Michael Smith, a married man, hold title by himself if his spouse does not sign the quitclaim deed? And the answer is yes. Right? He can. But he would have to have bought the property all cash. If you were to purchase this property with a loan, then that lender would not allow him to hold title as a married man by himself without his spouse signing the quitclaim deed. It just wouldn't happen. So, but if he's purchasing all cash, then we as a title company, we're okay with it. You would just hold title as Michael Smith, a married man, and that's it. There would be no sole and separate property, but the spouse doesn't need to sign. But eventually, the spouse will. So if Michael were to refinance the house, all right, or take a loan out on the house, then at that point, his spouse would need to sign. If Michael Smith were to sell the home, then at that point, his spouse would need to sign. So sooner or later, he or she would need to sign. All right. Now, here's a common question. If Michael Smith is holding title as a married man as his sole and separate property and he dies, does the property go to the wife? And the answer is not necessarily. All right. If Michael Smith is holding title as a married man, sole and separate, and he passes away, that property is going into probate, even if he's married. All right. Now, it might through the probate or go to the wife, but it's got to go through probate. So, one person on title is pretty straightforward: single, unmarried, widower, or a married man as his own separate property. Now, if you're holding title of more than two people on time, all right, then you have to choose one of these options. Now, you guys, if you've represented the buyer before, then everybody has seen this list. So I'll go over the key differences. I won't go over into the minute details, but just some of the key differences that most people really want to know. Says when we purchase house under husband name only. Yeah. So Linda, yeah, you just, when if you guys were ever to sell and it's, if you haven't signed the quitclaim deed, then you would just have to, okay. I see what your question is. So Linda's asking, like, what if we purchased a home? When the home was purchased, it was only one person, right? Let's say it's only, Michael only purchased it when the house was purchased. And then later on, they add the spouse's name on title. Do we need to get a new title policy? Generally, it's no. I mean, as long as one of the original insured person is still on title, then you're fine. You're fine. Okay. Hopefully that answers your questions, Linda. Moving on. I'm going to put this chat room on the side so I can monitor it. Okay, so let's go over some of these options. We'll just kind of brief through them. Now, tenants in common, joint tenant, community property right of survivorship. So, guys, if your buyer tells you this, if your buyer says, "Oh, hey, agent, I'm buying a property with my friend, and I want to have 60%. My friend wants to have 40%." Well, there's no other option. The only option is tenants in common. Tenants in common is the only option that allows people to hold separate interest. And anybody could be tenants in common: husband and wife, friends, siblings, parents, whichever. But it does allow you to hold separate interest. But with tenants in common, there is no right of survivorship benefit. So if A and B are entitled together as tenants in common, and then A were to pass away, A's interest would have to go to probate. All right? A's interest would have to go through probate. So, or what if you're holding title as, part of it is the trust and part of it is an individual, right? Let's say I'm buying a property of my friend, but I want my title to be under my trust. He's going to have his name, his portion under his individual name. So in that situation, it would also be tenants in common as well, right? Because part of it is in the trust, and trust already has all this estate planning built in. All right. So that's the thing of tenants in common. Joint tenants works almost the complete opposite. Joint tenants have to have equal ownership, right? So if I have 3 people on title, then everybody has 1/3 ownership. You can't change that, all right? If I have 4 people, then it's everybody's 25%, right? But with joint tenants, you get an automatic right of survivorship benefit. So that means if A and B are on title as joint tenants, A passes away, then A's portion does not need to go through probate. It automatically goes to B. How does that go to B? Super simple. All you do is you record a death certificate for A, and then B would sign this thing called an affidavit of death. And then you take those 2 documents to the county recorder, it records, boom, that's it, you're done. All right, no probate necessary. We have a question from Karen. What if the buyer purchases the property under the name and change? What if the buyer purchases the property under their name and change it to the family trust after the close of escrow? So Karen, your question was very similar to Linda's. So if it's going to your own trust, that's okay, right? If it's going from Jerry Wu to the Wu family trust, you know, it's my own trust, that's fine. If it's going to somebody else's trust, that's a whole different issue. But if it's going to my own trust, it's fine. All right, so that's joint tenants. You do get the automatic right of survivorship benefit. So it's a big plus. So the next one is community property and community property right of survivorship. They're really actually very similar. So for the sake of explaining, I'll just talk about community property right of survivorship. That's what most husband and wives are choosing right now anyway. So it's very similar to joint tenant, all right, except that it's only reserved for spouses, all right, only reserved for spouses. So it's husband and wife, could be husband and husband, wife and wife. Here in California, they do allow for same-sex marriage, so as long as they're spouses, all right? And you also get the automatic right of survivorship benefit, all right? You also get the automatic right of survivorship benefit. So as you can see, it's very similar to joint tenant. So a lot of people ask the question, well then, why is it that some husbands and wives choose this, some choose this? Yeah, I think it's just because joint tenant has been around forever. So a lot of people choose joint tenant, but I'm seeing more and more spouses choose this one. And the reason because is this has a better tax advantage if one person were to pass away and the surviving person sells. There's a better capital gains tax advantage, all right? That has to do with a thing called a step-up tax base, step up. So I'm gonna go back to my drawing board. So I'm going to do my best to explain to you guys how step up works. Now, my example will be super simple, okay? I know about, you know, you get a tax deduction of $250 on your net if you're single, $500 on your, you know, if you're married, plus the depreciation, all that stuff. I get it. But for the sake of explaining how step up works, I'm just gonna oversimplify, okay? I'm gonna oversimplify. So just try and follow me here. So let's say if you buy a property in 1981, right? And you buy that property for $100,000. That same property today is worth $1 million. This is the fair market value today. If I were to sell this property today, I would make $900,000, right? And yes, again, we're just gonna forget about all the exclusions, all that other stuff. We're just gonna go simple. If I make $900,000, I have to pay capital gains tax on $900,000, right? So pretty simple. So this is the way how step up works. Right now, your base value is set at $100,000. That's your base. If husband and wife are holding title under community property, right? And they bought this property, same scenario, in 1981 for $100,000. That same house today is now worth $1 million. and they're on title as husband and wife as community property right of survivorship. If the husband goes out and passes away all of a sudden, all right, let's say he passes away today. Well, what will happen is this base value will step up to the value on the day the husband passed away. Let me repeat that. So if the husband were to pass away, the base value would step up. It would go up to the value on the day the husband passed away. So what ends up happening is if the husband passes away today, well, this would be our new base value, right? It'd be $1 million because that's the fair market value of the property today. So if the house were to, if the wife is very sad, she wants to sell the house, she sells it the very next day, she's going to sell it for what? $1 million, right? Because that's the fair market value. So if she sells it for $1 million, the new base is $1 million. That means she has zero gains, right? So meaning she pays no capital gains tax. If she sells it for the following year for 1.1 million, her base is still $1 million. That means she only made $100,000. So she's only liable to pay capital gains tax on $100,000. So, which she wouldn't because she would have that, 250,000 exemption, but you get my point. Any questions? So a couple of questions. Does that mean joint tenants not get the step up? So joint tenants do. From what I understand, joint tenants just does not get the full step up, right? I think they maybe get half or, partial, but they don't get the full step up. So if title is held under the trust, so trust, you get a full step up too. So if you inherit so let's say if the kids or somebody inherits, they're the beneficiary of a trust, and then they get, the parents pass away and then they inherit the property through the trust, they'll get a full step up too. So what I was told by one of my estate planning attorney friend is the mistake he sees a lot of people do is, let's say you have parents and they have like 3 kids, right? And they have a trust set up where the 3 kids are to inherit the property. Now, if they pass away and the 3 kids inherit the property through the trust, they'll get a step up. But this is what they said. This is what they told me. So sometimes they'll have 3 kids and they'll hate one of the kids, right? Maybe one of the kids is really bad, is really not good to them. So what they'll do is they'll take it out of the trust and then deed it from them to just the 2 kids as individual. When that happens, the value stays the same. They do not get a step up. So it was it's a mistake. They said they should just translate, or they should just change the trust and who the beneficiary are in that case. Who determines the value at the time of death? That's probably the CPA and the IRS. That's why sometimes people come to the title company and ask us for comps from like 1999. They'll say, hey, can I get comps for this property from like 2005? But that's out of our jurisdiction. Probably it's up to, like I said, either the CPA or the IRS. So Linda's asking, so if someone passed away, value can step up. Otherwise, standard sale value will not step up. Still need to pay capital gains. That's right. Yeah, that's right. But remember, you still have your 121 exemption of 250 for single people and $500,000 for married people. All right. Okay, let's continue moving on and talk a little bit about trust. Okay, so we've already touched on trust. Trust is one of the best ways, in my opinion, to hold title if you have a family, right? Or if you just want to avoid probate in general. So here's the thing about trust. Now, I'm not a trust attorney. I'm not a trust expert by any means. It's not my field of work, but I can talk a little bit about it from the title sense. Trust, more or less, they all work the same way, okay? There is irrevocable, revocable, and all that stuff. But more or less, they all have the same roles, right? So they have your trustor is who owns this trust. So if me and my wife, we go to an attorney and we say, hey, attorney, make us a trust, right? We own the trust, we're the trustors. And then your other position, or your other role is the trustee. Trustee is basically who's managing this trust, right? Who we are assigning to take care of all the things we have specified in this trust. We are relying on this person or these people as the managers to make sure everything is followed. So if, oh, I see a baby. Hi. It's a cute baby. So that's the trustee. Now, usually speaking, the people who make the trust, the trustor, make themselves the trustees while they're still alive, right? After they passed away, they would specify in the trust who the successor trustees are. And then the third role is the beneficiary. The beneficiary is pretty self-explanatory. If it's a family, basically, usually the kids or whoever gets to benefit from the trust, all right? Now, if you take a listing under a trust, your trustee is who are the people who are signing, all right? It's your trustees. Remember, the trustees are who are managing this trust. Now, if for whatever reason, the trustee has passed away, right? And then at that point, we need to see a copy of the trust. You need to get us a copy of the trust for the title company for us to verify who the successor trustee is. All right. So we can't just take their word on it. We have to actually verify the trust. Now, here's a couple of good tidbits about the trust. You have to make sure if you have a trust to put the title of your home under the trust, right? I have this one file that we weren't able to work on. I feel so bad for the seller. Basically, his mom passed away and she had a trust. She made a trust. She even got a deed created, deeding the property to her trust, but they never recorded it, right? They never recorded the deeding the changing the property into the name of the trust. So she passed away as an individual, and now the property needs to go to probate, right? So you got to make sure that you do that. You got to make sure you change the title of the property to the trust. Excuse me. Another thing about trust, most trust, not all, but I would say most trust do not allow the trustees to use a power of attorney. All right. So let's say if you have a trustee that's selling the house and the trustee tells you, hey, Linda, I have to go out of the country for a couple of months. Can I give power of attorney to, my son or my daughter? And in that case, the first thing that we have to ask is, well, we got to see a copy of your trust, because the trust has to specifically state that the trustee can use a power of attorney for situations to sell the home. All right. And I would say 80% of trusts do not allow for that, because the idea is that the trust already is created to sort of establish, hey, who can sign on my behalf if I'm not around and so forth. So most times trusts do not allow for power of attorney. So please plan accordingly if you have that situation with the seller. Also, what if the trustee is still alive, but sort of incapacitated, meaning he or she is still alive, but they're mentally not all there, right? They're not really, they can't really sign, they're in a vegetative state, whatever the reason might be. If that's the case, we still have to look at the copy of the trust. We can only follow the instructions within the trust. And I will say this, most trusts that I see, it says that there will need to be 2 doctor's notes, all right, for a trustee to resign under a condition of not being able to act, all right? 2 doctor's note. And a lot of people fight us on that. They said, it's hard enough to get 1 doctor's note because my seller is in a nursing care home in another country, but why do we need 2 doctor's note? And I don't know what to tell them. I said, well, they should have structured their trust differently, but we have to follow the instructions within that trust. Is the trustee a beneficiary as well? You can, right? You can make your kids the trustee and you can make them the beneficiary. So you do not have to, the question is, do we also have to record the actual trust with the county recorder, all right? Not talking about the grantee, the actual trust. The answer is no. You typically don't want to, because there's so much personal information on there anyway. You don't want to record the actual trust at the county recorder. You just want to record a deeding from yourself to the trust. All right. So I got 15 minutes left. All right. What do we want to talk about? All right, let's talk about a couple of red flags on title. Oops. Okay, here we go. So, guys, so I'm going to talk about a couple of things that stall a transaction on the title side. If only my screen would work. Here we go. All right. So these are excerpts. These are taken from actual preliminary title reports. All right. These are sections that I've taken from preliminary title reports to show you guys some of the red flags or some of the things that we see that need to be addressed. All right. So this is something that you might see on the prelim. You might see a deed of trust. A deed of trust is a loan. Okay. It's just a, when you go to a bank to take out a loan to buy a house, they're going to put a lien on your house. And the way that they put a lien on your house is to record a document called a deed of trust, right? If you helped out a buyer before, when they go sign loan docs, this is one of the documents that they sign in front of a notary, deed of trust. Now, when that particular deed of trust is paid off, the lender needs to record a reconveyance. So on title, we're going to see a deed of trust, we're going to see a reconveyance, and then we're going to know, okay, this loan got paid off, right? Now, some guy in the 90s decided that he had this great idea. He's like, well, if I just forge a deed of trust, if I just if I just forge a reconveyance, then my home is free and clear, right? So that's exactly what he did. He started forging these reconveyances, and then he would record them, and now on title, his home looks like it was free and clear. And then, he would take out another loan, and then he would fraudulently reconvey that loan, and then he would take out another loan. I think he took out like 6 loans or 7 loans or something like that before people started catching on. It was pretty bad. So because of that instance, it's made title companies a lot more careful when they see a full reconveyance, on a loan. So we don't care so much if the loan was reconveyed because of a refinance. So again, if there's a refinance, what are you doing? You're paying off one loan, getting a new loan, right? So when you pay off one loan through a refinance, there's going to be a reconveyance. So when you do a refinance, we don't really verify the reconveyance. But if there's just like a reconveyance, you buy a house and then 10 years later there's a reconveyance, or 5 years later there's a reconveyance, then the title company is going to say, okay, we see a reconveyance, but we need further proof of payoff, right? So we need something else. Right now, obviously, if it's like reconveyance and they've had the loan for 30 years, we're not going to ask for that. But it's not so common. We see people pay off a 30-year mortgage in 5 years or 10 years. So in general, title companies will want to verify that payoff. Now, another thing then, back to this reconveyance thing. You also want to make sure if you do pay off a loan that there is a reconveyance recorded. You'd be surprised how often the lender or the trustee for the lender does not record the reconveyance after a loan gets paid off. They just forget. It happens, right? Human error. And then next thing you know, the seller doesn't, you can't blame the owner. I mean, they don't really know, right? But they go and sell the house years later, and then this loan is still showing up on title, right? And then we're telling them, hey, you have this open loan showing on title. They're like, no, I don't. I paid it off like 5 years ago. And we're going like, well, you got to get us something to show that it's paid off because it's still showing open. And then they're like, well, I can't because it was with Wachovia Bank and they're no longer around, right? Or it was with some lender and they're no longer around, right? And then so this becomes an issue that we have to address, all right? So make sure you get the reconveyance if you pay off the loan. Oh, the worst is for private loans, right? When you do a private loan, you get a loan from a private lender, right? A lot of private lenders, they're not like professional lenders, right? They don't even know that they have to get a reconveyance when the loan is paid off. And then next thing you know, we're asking for it and borrowers are like, I haven't seen this guy in like 10 years, right? So those are issues that we have to deal with. Let's go back to some questions. You know, I'm not sure, Linda, on the $500,000 exemptions. Can we only use it once in a lifetime or several times? I think you can use it several times as long as it's your primary residence, but that's probably a better question for CPA. I don't really, I think you can, but I don't want to step on their toes on that. Um, so another question, a buyer gets a home under her name. After she gets citizenship, she changes to a new name, totally changes into a new name. And then do we need to update the title policy? And generally, no. I mean, as long if your clients ever change their name, right? We see that every so often. They just have to be able to prove they're the same person, right? So maybe they have the name change certificate or like an old ID. They just have to be able to prove that they're the same person. And the same thing, right? What if you buy a property under your old name and then now you're selling it, it's under your new name? How do you sign, right? So yeah, no, most notaries just have to show that, oh, okay, you're the same person. I see documentation to prove that you're the same person. And we can, write the grant deed, or escrow will write the grant deed a certain way. We'll instruct them to do so in a certain way that will all make sense. I highlighted some other stuff. I mean, you guys will see these are pretty self-explanatory, like a judgment. Sometimes we'll see a judgment for child support on the prelim, a notice of HOA lien on the prelim, and most of the time when we see these, escrow just needs to go and get a demand from these people, from the HOA or from the court for this judgment. So that's why it's so important, guys, if you do take a listing, call, I prefer you call me, but I mean, you just got to call your title company and get a prelim. As soon as you get that listing, what I personally do for all my clients is I review every single one of the prelim that comes in. I don't think a lot of people do that. I actually review every single one of your prelims. I send you an email for every sale. We don't do that for refis, but for every sales, I review every report for you, and I'll let you know if there's any red flags and if it needs to be addressed early on. All right. So here's another one that we might see. It's this number 8. So number 8 is a request for something that's called a statement of information for, in our example, Loretta Madison. All right. What does that mean? You guys have all seen the statement of information before. It's just that one form that, what's your name? What's your date of birth? What's your social? Where have you worked? Where have you lived? Have you used any other name? You guys have all seen it before. So why we require that is because certain liens are not attached to the title, right? And so, for example, one of the good examples is federal tax liens from the IRS. The IRS doesn't, if you owe them money, they don't know how many property you own. They don't know like every asset you have. What they do know is that, hey, if you sell something and you get paid, then the IRS wants to get paid. So a lot of these IRS liens are only searchable through the statement of the information that's provided in that statement of information. Another thing is statement of information is also needed because a lot of owners have, or a lot of people have similar names, right? Let's say if our seller is John Smith, there's tons of John Smiths out there. How do I know which which liens belong to which John, right? And God, I hope it doesn't belong to our John, but if it does, we want to find out early. Where we run into red flags is sometimes either the seller will return the statement of information back to escrow really late, or escrow will get it back to us really late. And then we run the statement of information, and then boom, something pops up, right? And at that point, then everybody's pointing fingers because now we can't close on time. So if we need a statement of information, at least if it's one of my files, I will tell you, we need a SI, get it done, or even one of my clients, what she does is when she takes the listing, she has the seller complete the statement of information when she takes the listing. And then I'll talk about one more thing and then we'll wrap it up. This is a notice of building code violation, sometimes on a prelim, I don't know if I have an example here, but sometimes on a prelim, you'll see we'll say here's the owner subject to item 11, right? So then you'll just have to go to that particular item. And most of the time, guys, I'll tell you, most of the time when you see a subject to after the owner name, it has to do with an uninsured deed transfer. What does that mean? An uninsured deed is any transfer that's done after escrow closes. All right. So if I buy a property and then like a year later, I'm like, you know what? I'm gonna deed my property over to Laura, right? Because Laura's so cool. So here, you get a free house, right? It's completely legal. She's smiling. That's not gonna happen, but it's okay. um, but you know, for whatever reason, it doesn't matter. We see it all the time, right? And then when that happened, you can just draft a deed. I would sign that deed in front of a notary. We get it recorded, and then that's it, right? It's perfectly legal, but it's what's called an uninsured deed because there's no title insurance, right? So now Laura owns the home, and maybe 2 years later, Laura wants to sell the home. She puts it in escrow, and then title will then find out that there was an uninsured transfer between me and Laura. What the title company is going to do is they're going to say, well, Laura, I know you're selling the home, but I want you to go back to Jerry, and I need Jerry to sign this form, this affidavit stating he really did transfer title to you, right? The reason we do that is because we're trying to avoid any potential cases of fraud. What if I didn't really transfer? What if it was fraudulently transferred to Laura? Maybe she forged my signature, right? Maybe I was intoxicated that night. Maybe I'm a really old man and you know I don't know what I was signing. I signed my property over to 3 people. You know, we've seen it all, right? Especially in family situations where you know kids take advantage of their elderly parents and make them sign documents that they're not aware of. So we try to avoid that. Now, where the issue comes up is because we deal with a lot of minority groups in our community, a lot of people out of the country, you know, either in Mexico, China, wherever. And then now we're asking them to go back to find a person that perhaps is out of the country. So those become a little bit more of a headache. So educate your clients, let them know you can, you can do this, and we have resources for people to change title, but there might be a chance that they'll be asked to sign an affidavit again in the future. And most of those times the affidavit have to be notarized, right? Have to be notarized. So that can create a bit of more of a headache. So those are some of the most, some of the things that, you know, we see the most. I think that's going to cover it for everything I wanted to talk about. And I'll use the last few minutes in case if you guys have any questions. Feel free, you can type it in the chat group, or if you just want to unmute yourself, if you have questions, feel free. So. Nothing, not too much. Okay. Let me see.
Jerry, why don't you let them know that the class is being recorded?
Oh, yeah. So the class is being recorded. So if you guys want to go back and rewatch the class, just go back to the Tri-County website and you can access it through the Tri-County website. So Daniel, if you just go back onto the Trico Realtors website, tricorealtors.com, and you should be able to access the video again. Just a heads up, guys. How can I contact? Oh, I guess I should leave my information. I'm going to type my information in the chat group. So there's my information. I just typed in the chat group. I'd love to earn your guys' business. If you guys have a listing, please feel free to reach out to me. Would love to work with you on your next deal. We also offer some additional supports, like, you know, we provide free shoe covers for your listing, free shoe bins to put the shoe covers for your listing. I also got some wipes that you can use to wipe down, some hand sanitizers, those type of things, you know, flyer holders, although I don't think many people are using flyer holders now, but we provide those to you free of charge. I have we have offices all throughout. I have a local office in Diamond Bar, close to a lot of where most of us are. So you can always go stop by there to pick up some materials, again, free of charge if you need to. Hopefully we can earn your business that way as well. But you have my information. Feel free to contact me if you guys have any questions. And thank you again, Laura. Thank you again, Tri-County, for hosting this class.
Thank you.
All right. Thank you, guys.